Welcome to Economic Fault Lines, a deep dive into the seismic shifts reshaping the Australian financial landscape. Tonight, we examine the powerful currents altering everything from our property markets to our retirement savings, and the regulatory environment that seeks to contain them. Australia, often seen as a bastion of stability, is now navigating a complex interplay of global pressures and domestic challenges. TI, the catalyst and current state. The last few years have ushered in an era of profound economic recalibration. For many Australians, the most immediate and tangible impact has been felt in their household budgets and the relentless upward trajectory of prices.
It's like we're constantly running to stand still. Every trip to the national grocery chain feels like a lottery, and energy bills, they're just another weight. It's not just the big things, it's the cumulative effect on everyday life.
From a macroeconomic standpoint, we've observed a significant inflationary pulse, emanating initially from global supply chain disruptions post-pandemic, but quickly broadening across domestic services and goods. The official inflation rate, as measured by the Consumer Price Index, soared to levels not seen in decades, prompting a vigorous response from our Central Monetary Authority.
The Central Monetary Authority's primary mandate is price stability within a flexible inflation target. When inflation persistently rises above that target band, the institution is compelled to act. The series of cash rate adjustments initiated to tame this inflationary beast has had a profound and rapid impact on borrowing costs across the economy, creating ripples we're still grappling with.
This swift increase in the benchmark interest rate from historic lows has drastically altered the cost of credit, impacting homeowners, aspiring buyers, and businesses alike.
Our mortgage repayments shot up, it felt like overnight. Friends are facing the same, some even worse. It's hard to plan when your biggest expense keeps changing. We've had to cut back on absolutely everything discretionary.
The impact on household disposable income has been significant. Our analysis shows a noticeable contraction in consumer spending in non-essential categories, directly correlating with the increased debt servicing costs. Furthermore, the labor market, while remarkably resilient with unemployment rates hovering near historical lows, is now showing early signs of softening in certain sectors as business confidence moderates.
The Central Monetary Authority carefully monitors a wide array of indicators, not just inflation, but also employment, wage growth, and global economic conditions, to gauge the appropriate stance for monetary policy. Their communication signals a commitment to bringing inflation back into the target range, even if it entails a period of constrained economic activity.
This is the current state, an economy in transition, where the forces of inflation and rising interest rates are testing the resilience of households and businesses across the nation. T2, underlying structural drivers. Beyond the immediate headlines of interest rates and inflation, deeper, more entrenched structural forces are at play, shaping Australia's long-term economic trajectory.
One of the most significant long-term drivers is Australia's evolving demographic profile. We're seeing an increasingly aging population, coupled with steady but fluctuating migration patterns. This demographic shift has profound implications for the workforce, productivity, demand for services, and crucially, the housing market. An expanding population, even with an aging cohort, fuels demand for housing and infrastructure.
From a policy perspective, understanding these demographic trends is crucial. An aging population impacts the fiscal burden on future generations, particularly concerning healthcare and aged care services and the viability of long-term superannuation payouts. It also influences capital allocation decisions within the broader economy, as investment shifts towards sectors catering to an older demographic.
You feel it when you try to get a doctor's appointment or when you see the cost of aged care. It's a starn on public services, and for younger people, it feels like the goalposts for our own retirement are always moving further away.
Another powerful undercurrent is the shift in global trade dynamics and the increasing geopolitical fragmentation, which directly impacts Australia's resource-exporting economy.
The global demand for our key commodities, particularly iron ore, natural gas, and other critical minerals, remains robust, albeit subject to cyclical fluctuations driven by global manufacturing and development. However, the nature of these relationships is evolving, with increased emphasis on supply chain resilience and diversification, potentially leading to new trade partnerships and investment flows into strategic industries.
Australia's unique position as a major commodity producer makes us susceptible to global price swings, which directly influence our terms of trade and national income. The Central Monetary Authority consistently models various global scenarios to assess the potential impact on domestic inflation, growth, and financial stability.
When global events happen, like shipping issues or conflicts, we see it immediately at the petrol pump or in the cost of imported goods. It shows how connected we are, but also how vulnerable.
Finally, technological acceleration and digital transformation are reshaping industries, productivity, and employment, creating both opportunities and challenges for the Australian workforce.
The adoption of automation and artificial intelligence is driving productivity GNS in some sectors, while necessitating skills returning and adaptation in others. This technological shift influences wage growth patterns and the composition of the labor force, creating a divide between those with in-demand digital skills and those whose roles are becoming automated.
These structural forces, demographics, global shifts, and technological evolution form the bedrock upon which our immediate economic conditions are playing out. T3. Institutional and consumer divergence. The interplay between institutional policy and the lived experience of consumers often reveals a divergence, particularly evident in the current Australian economic climate.
While the Central Monetary Authority talks about bringing inflation down, for families like ours, it feels like everything just keeps going up. Our wages aren't keeping pace with the cost of essentials. The dream of owning a home feels further away than ever, even with interest rates rising. The property market, especially in major urban centers, seems to operate on a different plane.
The residential property market, an asset class deeply embedded in the Australian psyche, has demonstrated remarkable resilience, despite the sharpest interest rate hiking cycle in decades. While initial rate increases did lead to some market cooling and price adjustments, particularly in the premium segments, robust demand and constant supply have largely mitigated a sustained downturn.
The factors contributing to this resilience are complex, ranging from ongoing population growth, limited new dwelling supply, and the continued flow of capital into the sector.
Historical data shows that Australian property markets, over multi-decade cycles, have demonstrated strong long-term capital growth, often outperforming other asset classes. However, past performance is no guarantee of future returns.
The Central Monetary Authority closely monitors trends in credit growth and household indebtedness, given the significant proportion of household wealth tied to real estate. While the Central Monetary Authority's direct influence on housing supply is limited, its policy decisions indirectly impact affordability by altering the cost of borrowing for both developers and consumers.
Meanwhile, our unique superannuation system, a mandatory retirement savings scheme, continues to evolve as a cornerstone of Australia's financial stability and a massive pool of domestic capital.
The superannuation system, now holding trillions in assets, plays a critical role in domestic capital markets, providing long-term funding for major projects and acting as a significant investor in various asset classes, from equities to infrastructure. The increasing size and maturity of the system means that as more Australians enter retirement, the balance between accumulation and drawdown phases will shift, presenting new challenges and opportunities for fund managers and regulators.
Superannuation feels so distant when you're struggling to pay the bills now. We know it's important, but it's hard to focus on a future benefit when the present is so challenging.
The performance of superannuation funds is inherently linked to the health of the broader economy and global financial markets, as their portfolios are diversified across various asset classes. Recent market volatility has highlighted the importance of long-term investment strategies and the benefits of diversification within these funds, despite short-term fluctuations.
The regulatory landscape, under the purview of bodies like the National Financial Services Regulator, is also adapting to these shifts.
The financial services regulator's role is critical in ensuring market integrity and consumer protection, particularly in an environment of rapid technological change and increasing complexity of financial products. Ongoing efforts focus on enhancing transparency, safeguarding consumer interests against misinformation, and ensuring that financial institutions operate within a robust and ethical framework.
This divergence between the macroeconomic indicators and policy actions and the everyday realities of Australians presents a complex picture of a nation striving for equilibrium. TFI, Forward Macro Projections. As we look ahead, the trajectory of the Australian economy will be shaped by how these underlying forces interact with ongoing policy responses and global developments.
The Central Monetary Authority projects a gradual return of inflation to the target band, predicated on a continuation of current monetary policy settings and a softening in domestic demand. However, the path is not without risk, particularly from persistent global inflationary pressures or unexpected shifts in international trade and energy markets.
Our models indicate that the labor market is likely to cool further, with a moderate increase in the unemployment rate expected as economic growth slows. This rebalancing is a necessary component of bringing inflation under control, but it carries the risk of impacting household confidence and spending.
For people like us, any talk of a slowing job market is worrying. It adds another layer of stress, especially with how hard it is to get ahead already. We just hope for stability.
The property market, having demonstrated surprising resilience, faces continued scrutiny. What are the forward projections for this foundational asset class?
While the pace of growth may moderate, fundamental demand drivers such as population expansion and limited urban land supply are expected to provide underlying support to residential property values over the long term. However, sustained high interest rates or a significant economic downturn could introduce headwinds, making it a market subject to careful observation.
Policy discussions around housing supply and affordability will likely intensify, exploring various mechanisms to alleviate pressure on both rental and purchase markets without distorting broader economic stability.
And what about our superannuation system, this immense pool of national wealth?
The superannuation system is projected to continue its growth trajectory, becoming an even more dominant force in capital markets. As it matures, the focus will increasingly shift to sustainable investment practices, the efficient management of funds in the drawdown phase, and ensuring equity across different generations of retirees.
We can expect greater emphasis on diversified portfolios, including increased allocations to alternative assets like infrastructure and private equity, as funds seek stable, long-term returns in a lower-growth global environment.
Knowing that our super is invested in things that can help the country grow, like infrastructure, gives you a bit of hope for the future. It feels like our small contributions are part of something bigger.
The next chapter for the Australian economy will undoubtedly be one of adaptation and strategic navigation. From the bustling urban centres to the vast regional expanses, Australians will continue to demonstrate their characteristic resilience in the face of evolving economic realities. Understanding these powerful shifts, from the immediate pressures of inflation to the long-term structural changes, is crucial for charting a course through this new economic normal. Join us next time as we continue to unpack the forces shaping Australia's financial future.